recognize.
Yep, we'll go ahead and get started here. Thanks to everyone for joining us today for our first-time homebuyer webinar presented by Hanscom Federal Credit Union. I'm Leah Van Tassel from Human Resources, and also on the call from HR today is Jennifer Barnhart, who helps facilitate our wellness programming.
Hi, everyone. Thanks for joining.
And also like to introduce Bill Burpo, who is a financial wellness coach at Hanscom Federal Credit Union and who has been a great partner in setting up the partnership with TCB for this webinar. So thank you, Bill.
Very welcome.
And it's our pleasure to introduce our speaker for today, Scott Berry. Scott is a branch mortgage officer at HFCU and a native of Canton, Massachusetts, and a graduate of Sacred Heart University. He has over 12 years experience in the mortgage industry, the last 6 of which have been with HFCU. So thank you, Bill and Scott, for joining us today. And before we kick it over to them to get started, we're going to do a quick poll for folks to chime in and say where they're joining from for a location, which will help steer the conversation based on what housing markets folks are interested in. So I'll let folks answer that, and then we'll kick it over to Bill and Scott to get started.
Sounds good. Leah, your staff here is very quick. They didn't even have to talk to the poll, and we're getting just about everybody's answered. A couple more if you want to let us know where you're from, that would be awesome. So I'm seeing 8 from the Northeast, 2 from Mid-Atlantic, and 2 from the Midwest. I'm going to end the poll. I'm hoping it will stay up on your screen. If the poll stays there on your screen, I'm share the results now. And you may have to click the X just to move the box off the screen. Sometimes Zoom's a little funny with these things. So I see 71% from the Northeast, 14 and 14 from Mid-Atlantic and Midwest. Welcome, everybody. I'm a bit jealous of those of you out in the Midwest. If you're on Central Time, I grew up in Texas and I very much miss Central Time now that I live on the East Coast. Things happen just too late for me over here. I end up missing everything because I have to go to bed. Anyway, so glad you're all with us today. My name is Bill Burpo. I'm with Hanscom Federal Credit Union, and I'm just going to speak very quickly about the credit union. We have a vision here that our members are very engaged in their financial wellness, and they are empowered and they know how to make good financial decisions. That's really what we are all about. How do we do that? There's a lot of different ways we do that with people. But today's way is one of the main ways, and that's through webinars and through education. And today, that's what this is all about. It's about mortgages. So you are very, very brave people to be on this call. How do I know you're brave? Because you're even looking at the housing market right now, which has been just simply crazy what's going on. The rates are up, home prices are up, and you're very, very brave to be walking or even looking at this market right now, but you're being very smart. And what you want to do now more than ever is to really understand the process, to understand what the process is you have to go through to purchase a home. And there's just a lot of steps there. But in times like these, you want to have that down pretty pat. So that's what we're going to talk about for the remainder of the session today. Is Scott Berry is going to walk you through the mortgage process. I just want to encourage you to ask any questions. Scott and I are both in the Northeast, but even if you're calling in from the Mid-Atlantic states or the Midwest, just let us ask the question anyway. And if we don't know the answer, Scott or I will do some research after and follow up with you on it. Our intent today is just to make sure you get the information you need out of this webinar so that you can make better decisions and be better prepared to purchase a home. So it's a very intense topic. I will warn you that you're going to get a lot of information today, a whole lot of information today. if you're not understanding something or we go too quickly by something, just put that question in the Q&A, and we'll revisit it. Slow us down. We have time today. Get the questions answered that you need answered. So Scott, in this crazy market, tell us what we're looking at here.
Yeah, thanks, Bill. And to kind of hit on that point that you were mentioning about, member education, this is really a big reason why I enjoy working at Hanscom. My position at just about any other company, a mortgage officer position, is so sales focused, and you really need to sell those loans and to hit those numbers. But because at Hanscom we have a lot more focus on education, I have the flexibility to do things like this and really ensure that our members are getting the information they need and getting into the right product for them, whether that be with us or with another lender. So I feel really blessed to be here and working with Hanscom as part of that end goal to increase our members' education. So getting right into it. First-time home buyers. Who is a first-time home buyer? At least one person going on the loan has not owned a home in the last 3 years. So it could be, someone who truly has never owned a home before. It could be somebody who owned a home but sold it a decade ago, or as long as one person hasn't owned a home in the last 3 years, you do potentially qualify for a first-time home buyer program. Here at Hanscom, our first-time homebuyer benefits, I always say, are primarily targeted to offer you lower down payment options. We do offer as low as a no money down loan, which I'll get into in a little more detail as we move along. We also offer 3% down payment loans for people who might not qualify for that no money down product. We do have a variety of mortgage products. We have some adjustable rate mortgages that are a little bit easier on first-time home buyers than a typical adjustable rate mortgage. And then just, like I already mentioned, the no money down. The steps to buying a home are basically going to be more or less the same in just about any state. Some states have slight differences, so I know people are calling in from across the country, so there are local customs and norms that might be a little bit different state to state, but the basic idea is you want to start by getting pre-qualified for a home. Basically, a pre-qualification letter is going to be a letter from us or your lender stating that you are pre-qualified and likely to get approved for a mortgage. It makes you a serious buyer rather, if you're going to put offers in on a home. If you're getting a mortgage, no one's going to take you seriously without a pre-qualification letter. After you get that, you want to get in touch with local agents. I always recommend finding a good agent. They can be extremely helpful as you go through the process. They'll help you find a property, help you put in an offer on a property, and get you to the purchase and sale. And then after that, we'll go through the process of, ordering the appraisal, title work, gathering documentation from you, pay stubs and potentially tax returns, verifications of employment, all that kind of stuff as we process the file, underwrite it, and then get it cleared for closing so that you can finalize that purchase. Some of the key people that you'll be working with: mortgage loan officer, that's someone like me at the credit union or at your lending institution of choice. They're going to assist you through the application process, work to get you pre-qualified, work to get the loan into process once you have an accepted offer, and basically be your main point of contact as you go through the application process. You'll want to work with a buyer's agent. As I said, they'll be the ones who can help you find homes, help you put in offers on homes. I always think it's a very important step to work with a good agent. You may be You may talk to the listing agent a little bit, especially if you go to open houses or anything like that. They are working in the best interest of the seller. They're the ones who are trying to negotiate the highest selling price, get the most money for the property, basically. Various attorneys and title companies that you'll work with as well. The lender's closing attorney or title company, they'll be the ones doing the title work, processing the closing. You may have your own attorney. Again, this is where state to state it can be a little bit different. Some states you might really want an attorney, other states you may not be required to have your own attorney. So there's different things around the country there. And then the seller's attorney will also be involved. You probably wouldn't have too much contact with the seller's attorney, but they're all involved to help clear any potential title issues or help make sure the process, from a legal standpoint, goes along smoothly through the closing.
So Scott, a quick question on that. With the attorney, that the realtor, if you have a good realtor, they're going to know whether you need an attorney or not, right?
Absolutely, yeah.
So that'll be a key question to
another-
ask.
Another good reason to work with a good local agent. The agent's really going to know all the norms and how the process works on a state to state level. We do lend across many states across the country. But when it gets outside of our main lending zone, we're not as, if I do a couple of loans in, I don't know, Kansas a year, I'd be surprised. So I don't really know all the customs there. I just picked a state at random, but that's why it is important to work with a good agent as well. And then there's all kinds of other reasons to work with a good real estate agent. They may have listings that aren't actually, contacts for listings, I guess, that aren't on the market yet. They are the ones that take the time to find out what you want and find out where you can afford what you want and help you find the ideal home. They'll help protect you with contingencies. Having a good agent is important for all of these and more. Basically, anytime I talk to somebody who has worked without an agent, they talk about the nightmare experience that they have. Or with a bad agent, you can still have a nightmare experience, but a good real estate agent will really help coordinate all the parties and help you have a good experience. So I do strongly recommend working with an agent. I don't see any real downside to having an agent on your behalf. As Bill alluded to, we were talking at the beginning, there has been a crazy housing market, although I think this is calming down a little bit. But if you are in a position where you're going to offer more than asking price, you want to make sure you have a good appraisal contingency involved. Basically, without an appraisal contingency, you'll have a deposit that you've put down with the seller already. Without an appraisal contingency, if the appraisal comes in low, you can try to renegotiate, but you without an appraisal contingency, you've almost waived your ability to try to do that. You can make up the difference in cash. You can try to challenge the appraisal, or you could potentially walk away. The issue is if you walk away from the deal because of a low appraisal and you don't have an appraisal contingency, you could be giving up thousands of dollars. So it is very important to have an appraisal contingency, especially in the market where it is now. It feels like, the market is constantly changing, and you want to make sure you're protected right now, where we've kind of come out of this crazy market that prices were spiking and spiking, and now we're kind of getting into, I think, a more stable or traditional market, although it could potentially turn the other way. Having an appraisal contingency, I think, is really important right now.
So Scott, just make sure I'm clear. The appraisal contingency is simply that if the appraisal of the home comes in less than the price you've agreed to pay, then you can negate the deal. You can walk away without
Yeah.
penalty.
I mean,
Okay.
you can do basically any of these with these options with or without an appraisal contingency. It's just the appraisal contingency protects any deposit that you have, basically. Gives you the ability to walk away and get your deposit back. So without it, if you walk away, you're probably walking away from thousands of dollars that you already put up on the table as a down payment.
Yeah, and a good realtor there again will definitely insist that you would include something like that. You'd want to have a conversation with your realtor. Yep. Thank you.
Absolutely. So when you're trying to get qualified, what do lenders really care about? Income and employment is a big part of it. We want to ensure that you have the ability to repay. We are going to take a look at your credit score, and we want to make sure you have sufficient funds for the down payment and closing costs. That's kind of a simplified view of it. There is a lot that goes into qualifying for a mortgage, but from a consumer's perspective, it's these 5 things that really are the focus of what we're looking at to get you qualified. What can you qualify for? This is a very generic rule of thumb. I'm not a big fan of it, but it can give you a starting point for where you might be looking. If you have a lot of debt, you're going to qualify for less. If you have very little debt, you can get a lot more. So you can kind of see how this example works out in your own life. A more precise way to look at it is to just calculate your debt to income ratio. So the way that I always describe this, we can do a max debt to income ratio of 50%. So take your gross monthly income, use 50% of that, subtract any debts that we're going to see on your credit report. And then what's left is theoretically what I can approve you for a housing payment. Now, that housing payment has to include the repayment of the mortgage, taxes on the property, insurances on the property. Like I said, we can go up to 50%. Ideally, you want to be a little bit closer to like 30-35%, I think is kind of what they say the ideal number is, but it's all a matter of making sure that you're comfortable with the projected payment. I can go through the numbers and figure out what I could potentially qualify you for, but it's more important that you get into a payment that you're comfortable with. You're going to know your budget way better than anybody else, way better than I'm going to, and I'm going to look at a lot of your financial information to get here, but your budget's going to be way more important. Some people, being on the max side of the debt to income ratio is perfectly comfortable. For other people, they want to save more on a monthly basis, so they want to be a little bit lower on the debt to income side.
Scott, we had a great question come in on this. Does a lot of debt include student loans? I know those are considered to be good debt, as opposed to, say, credit cards.
Student loans will factor into your debt to income ratio. I know a lot of them right now are deferred, no payments being made on them. What we do is we project a payment of 1% of the outstanding balance. It is people with a lot of student loans this is where a lot of them run into struggles is on their debt to income ratio. I've worked for years with, I know one client I've worked for years with who has a lot of student loans, and he and I have gone through a lot of different applications together, and we're trying to get him to a place where he can qualify still, but they are factored into your debt to income, so they are going to impact how much you can qualify for at the end of the day.
Yeah, debt is debt, so they will be included in that debt to income ratio.
Correct.
And I just want to reiterate Scott's point because it's so important. when you go out and talk to a mortgage person, they're going to give you a number for debt to income. It is so important for you to own that number. You want to do the math. You want to make sure whatever your mortgage payment's going to be, that you're comfortable there. It's so important that you own that number and you're comfortable with your payment. Or there's just too many times people get talked into a higher mortgage than they can afford. And then that just leads to trouble down the road. I've seen it happen more times than I care to think about. So really dig into this number some more after the webinar. If you have questions, you can always reach back out to Scott or myself on debt to income. But just make sure you're real comfortable with that payment. Scott, you said it well. I just trying to hammer that point home because it's so important. We have one other question. For two-person income spouses, is it best to do the person who has the better ratio, or can you combine both on the debt to income?
We're gonna combine both. So the answer to that question at the end of the day is a little nuanced, and it's going to be personal from situation to from person to person or couple to couple. But generally speaking, you're going to be better off with both incomes on the application, because then you're taking the gross income of both of you. And unless one of you has a significant amount of debt that's going to offset most of your income, then having both of you on it, you'll get qualified for more. Again, getting qualified for more, it goes back to making sure you're budgeting and you know what you're going to be comfortable with for payment. So generally speaking, it's going to be better with two people on the application if you're trying to get qualified for more.
Very good. And that's something to sit down and work through, which, if you need to pay down some debt, which to pay down and the best way to do that. That'll be all things to think about through the process. What about someone with not a lot of credit? I know we're going to hit credit in a bit, but that question just popped in. So you have someone without much credit. What, Ben? Or
I see. That's going to come down to the credit score, and if we can get a credit score. So that is where it can be a little more nuanced on whether you want to include a spouse or not. If you have a spouse with significantly lower credit, that might give you a bad interest rate, or may even prevent you from qualifying altogether. That's when it's going to be better off to do it with one person instead. Again, I've gone back and forth with various people and doing it in different ways with that, but that's usually where if one of the couple has a lower credit score, that's going to impact the pricing of the loan. Say one's at 800 and the other's a 650 or something like that. That's when, if you can qualify with just one income to get what you want, you're probably better off to do it that way.
very good. Thank you.
The employment side of things, generally we're looking for a minimum of a 2-year employment history in your fields. If you're self-employed, we might want to see a little bit longer, because basically for self-employed individuals, we're going to look at tax returns. We want to see 2 years of tax returns. So if that first year was a startup year, you might not actually be showing a very good income. But 2 years employment history with W-2 income is acceptable. We can look at education to meet that 2-year requirement as well. It doesn't mean you have to have 2 years at your existing employer, just 2 years that we can see that's in the same relative field of work. As you're looking around at homes, you want to assess, what you're getting when you're looking at different websites. So estimated payments, I don't love using website estimated payments. I think it's always going to be wiser to go back to your loan officer and say, hey, listen, can you run this scenario for me? Can you run that scenario for me? But basically, you can see here the same property on two different websites showing a very, very different projected payment, hundreds of dollars in difference. You know, there's whether taxes and insurance are factored in, what your down payment is, you know, all those things may or may not be in these calculations. So either, you know, Google mortgage calculator and run the numbers yourself, or go back to your loan officer and talk about what a payment is actually going to look like on a property. And your agent may actually want you to come back to us if you're actually going to put an offer on a property. Again, different agents will take different approaches here, but some of them really prefer that your pre-qualification letter be tailored specifically to your offer. So if you're putting a $400,000 offer in, they might want your letter revised to say 400,000 with 20% down payment, or whatever the situation might be. So another reason why it's important to work with a good agent. So getting back to the credit, we will, for mortgage lending, we will pull from all three credit bureaus. We're going to throw out the top and bottom scores and use the middle score as your indicative credit score. And this is where if you have two applicants and one has a lower score, the lower of the two is used for the pricing of the loan. So as you can see in this chart here, you know, if one of you has a 750, you're going to get some of the best interest rates that are available. But if your co-borrower has a 640, you know, we're going to be pricing it on that lower credit score. So just, you know, you might not end up with the benefit of your high credit providing you the better interest rate. So this again is where, you know, you can play with it a little bit. Two incomes is generally going to get you qualified for more. But if the person with a 750, 760 credit score, if they can handle it on their own, they might be better off because they might get a better interest rate and in turn a better monthly payment. 620 is, you know, once you drop below a 620, it's going to be really tough to qualify for a mortgage at all. There are some specifically FHA loans that will go a little bit lower. But you know, that's when we're looking at credit. That 620 number is pretty hard to get you qualified for most things. This is just about VA loans. I don't know if anybody out there is a veteran or not. If you are an eligible veteran, a VA loan can be a really good option for you. Basically, it allows you to put no money down for a property, and it does not include a mortgage insurance on it. Sorry. It does potentially have an upfront funding fee which can be potentially rolled into the loan amount, so you don't necessarily have to pay it up front. It may be waived if you're a disabled veteran. But basically VA loans are a really good option for our veterans. If you qualify for it, it can get you maybe a little bit lower interest rate. You can qualify on a lower credit score without too much of an impact to the interest rate. Just overall really good benefit to our veterans, I think. So I have this slide in here just to show what the difference in property tax rates can be across different states. I know we have people from across the country again here. In Massachusetts, Boston area, it's not uncommon for people to tell me they want to go up into New Hampshire to get a lower, because the home values are a little bit lower. The flip side of that is that tax rate on properties in New Hampshire is a lot higher. So if you're looking around and considering different states, this is one thing to look at. Tax rates are, you know, varying from, again, depending on the state, can even vary from town to town or county to county. So it is important to kind of look at what you're getting into as part of your overall housing payment on the property.
I'll just add here, Scott, because I actually live in New Hampshire, and when the housing prices went crazy, they did a quick assessment and reassessed all our homes. They actually dropped our tax rate, but because the home value had gone up so much, our taxes ended up going up anyway. So it's an important key feature when you're figuring out what you can afford, is take a good look at property tax. As far as I know, New Hampshire is the highest in the nation on property taxes, because that's where all the revenue comes from. Some states it's very minimal. So you just want to make sure and check that up front.
Yeah, they love to do that when they're reassessing home values. They can that way they can say they cut your tax rate, but you still end up paying more. I think they like the people running the tax office like to say they cut your rate, and then so it's important to consider a couple of different things as you're reviewing potential options for your loan product. Fixed versus adjustable is probably what a lot of people consider. Conventional versus a jumbo, that's going to really depend on the county you live in and the property value you're looking to get. If your loan is above a certain amount, depending on the county you're in, it's going to be considered a jumbo loan. Fixed versus adjustable is what you want to consider as first time home buyers. How long are you going to live there? How's your is your income going to change over time? Right now, I have a lot more people going for adjustable rate mortgages. The introductory rate on the adjustable rates is lower. They are fixed for a certain period of time as well. So it's a good option for potentially a starter home that you might only be in for 5 or 6 years. Or it's just a little bit lower rate. So even some people are thinking they're going to refinance before it starts adjusting. So fixed rate gives you the stability of knowing what your interest rate is for the long term. Those are the main differences there. Obviously, VA I kind of touched on a little bit, can be a really good option for veterans. FHA can be an option for people with lower credit scores who either are unwilling or don't have the time to put in to increase their scores prior to purchasing a home.
Scott, I'm going to put you on the spot on that last slide. I'm sorry.
Yep.
But what's an example of when someone might want to do an adjustable rate? I mean, you hear about 30-year fixed rates all the time, and but is there a specific situation where somebody might want to do an adjustable rate mortgage?
I mean, the most obvious example to me is when you're buying a home knowing it's a starter home and that you plan to move out, in 5 years or 6 years. You get a 7/1 ARM and it's fixed for the first 7 years. So you're not worried about that adjustment. Right now we have a 30-year fixed is in the low 6s. You can get an adjustable rate in the 4s. So when people are looking at it right now, depending on how much you're borrowing, that couple percent can be hundreds of dollars a month that's in your pocket as opposed to going to your mortgage payment. So there's a lot that factors into it, and there are some protections with the adjustable rate mortgages that I'm going to get into on a later slide as well.
Very good. Thank you.
So this is our no money down program. The thing I'm going to note really quick, because I do know that we have people from different areas. Again, this is only available in New England and Virginia, Maryland, and DC. Those states have been chosen because that is based on where our branches are. Most of our branches are in New England. We do have one branch in Virginia, I believe it is.
Virginia.
So, that's why those areas were selected for this product for us. Again, it has to be first-time home buyers, cannot have any no occupant co-borrowers. It is what's referred to as a 7-1 arm. So what that means is it's fixed for the first 7 years, and it can adjust every 1 year after that. This is only available for single-family homes or condos. We do have a 5% down payment option for multifamily homes now. And this, I didn't update this slide, but this is now available to people with a 700 or higher credit score. We do have a slightly lower debt to income ratio. You do have to pay the closing costs out of pocket. That cannot come as a gift, has to come from your own savings. And then we want to see what we call reserves, basically 2 months of the mortgage payment saved up, so that if you hit a hard time, you show that you have some money saved up so that you can keep making the payment. And then making sure you have sufficient funds for closing. So this is a rough example of a $500,000 purchase. Again, with people in different places across the country, closing costs could vary widely from state to state. And some states have more seller paid closing costs than other states. Again, the settlement title company and or attorney is going to know all about that stuff. Your agent probably will know a bit on what's common if the seller pays in states. So those numbers could be a little bit different, but basically a 3% down payment example here on a $500,000 purchase, you'd be looking at needing somewhere in the ballpark of $25,000 at the time closing. Any deposits you put down with the signing of the purchase and sale would be deducted from that, but you want to be prepared to put that kind of money into your initial purchase. Obviously, if you're looking at a higher down payment, you're going to have a higher number there. Where can a down payment come from? Seasoned accounts, basically money that's been in your accounts, checking savings account for the last 2 months. Retirement accounts could be, you could borrow from your own retirement account and pay yourself back over time. Not allowed on the no money down, but allowed in most other circumstances are gifts from a relative. They must provide a gift letter stating that it is a gift and not a loan. And we'll have to document that those funds as well. Net equity could be, that's generally going to be if you own a home already and you sell it, you're using the proceeds of the sale from that home towards your down payment on a new home. Could be a gift of equity if you're buying a home from a family member, but you'll have to meet the same requirements as getting a gift from a relative. So it would have to be outlined in the contract, and it would have to be from a actual relative. Title insurance, specifically owner's title insurance, is going to say that it's optional. I always recommend that people get title insurance. Lender's title insurance will be required. Title insurance is just like any other insurance. You want it if you need it. You hope you never need it. There could be issues with the sellers. There could be liens on the property that weren't found during the title search. The title insurance is what's going to protect you in those circumstances. I remember a story about a woman who sold a property, and a couple of years down the road, someone showed up acting like it was their property, and the woman who had sold it to them had fraudulently sold it. She was one of the owners, but she had a sister who was also an owner on the property who never signed anything. So it was a fraudulent sale. Title insurance is what's going to protect you. If there's court costs involved, if there's a legal battle involved, or if there's additional costs involved in getting the title clear at that point, that's why you're going to want it. Again, you hope you never need it. It's a one-time thing that you pay for upfront. It's not like your car insurance where you pay it monthly. You pay it once, it protects the title for the entire time you own the property. And, you know, if you need it, it could be, especially in a fraudulent sale situation like that, that could be something very, very expensive for you to try to fix on your own. Think court costs, think getting your own attorney. And the title insurance is what's going to basically absorb all those costs. So it's, I think, very important. Hopefully you don't need it, but if you do, you want it. A lot of people, especially in the way the market's been the past few years, have been looking at more distressed properties, either foreclosures or short sales. It's important that you know what you're getting into with these things. They can be perfectly fine properties that maybe require a little bit of sweat, elbow grease to make it look nice, or there could be serious issues with the property. So it's important to know what you're getting into. If you see a listing that says it is being sold as is, I would say that should, I don't know if, not a red flag, but at least the yellow flag should go up in your head at that point. If they're listing it as is, it usually means it's going to be difficult for you to get financing on the property. In turn, it basically means the property probably isn't habitable the way it currently is. So lender's not going to touch it. In that situation, you'd have to look either at a construction loan or a rehab loan. But that's going to be a much more involved project as far as getting the house into livable conditions. So that as is should be a warning sign if you see that on a listing. These are major no-nos that you want to avoid while you're going through the process. You don't really want to change jobs. Underwriting doesn't like it if you change jobs. And if you become self-employed in the middle of the process, you can, you know, if you go from W-2 to being self-employed, then you're talking, you're at least 2 years, if not 3 years waiting before we're going to be able to get you to qualify. You don't want to, you know, build up credit card debt. You don't want to make big purchases. You don't want to spend your down payment money. You know, you don't want to go out and buy all that furniture for the new house and rack up debt in the process. And then suddenly we can't qualify you at the very end and you don't have a house to put that furniture in anymore. So you want to avoid that stuff until after the loan has closed. There can be some circumstances, you know, if you really need a car and you need to get an auto loan for it, talk to your loan officer about it. You know, we can try to figure out what kind of impact something like that's going to have on your qualification. But generally speaking, I would avoid that while you're going through the process, if possible, and just try to be upfront with your loan officer about anything else that you might be doing. So this is kind of what I like to view as a good option for especially first-time home buyers. Try to figure out what kind of price range you want to be in. We can figure out what that is going to look like as far as a cost, and then figure out what you're paying in rent versus that potential payment, and then, you know, make these practice payments like it says in this example to help put money aside every month. It's going to do a couple of things for you. It's going to help you build up the savings that you need for that down payment. It's going to prove to, you know, yourself that you can make those payments, and then just overall is going to put you in a much better position. You know, just a couple months of doing that and you have a good amount of savings to put toward some of the closing costs. I mean, that's really it. Have my contact information here. Obviously, feel free to reach out with any questions. I'm always happy to run any scenarios for you guys as well. Whether it's, you know, somewhere that we lend or somewhere that we don't, I want to make sure that you guys are in a good position. to purchase a home. So I'm happy to help you. Like I said before, whether it's with us or if you end up with someone else, I want to make sure that you're getting into a good product and that you know what you're getting into. So good luck with the search, and let me know. I'm here for you guys as a resource if there's anything I can do for you.
Thanks, Scott. We're gonna leave it open. If you wanna pop in a few more questions, we'll just have a little discussion at the end. We do have one question, Scott. Could you please remind us what PITI stands for?
Yes,
Very
PITI
good
is
question.
Principal, interest, taxes, and insurance. That's what makes up your mortgage payment every month. That's what makes up your housing payment every month, is what I should say. So the principal and interest is the repayment of the mortgage. Your taxes are the real estate taxes on the property, and your insurance is going to be your homeowners or hazard insurance, as well as any mortgage insurance if that's required.
Very good. I'm just typing a quick note here to one of the participants. I wanted to mention too, please, if you have questions about mortgages, bring them in. I wanted to make a point about your credit score as well. When any mortgage company pulls your credit report, they're pulling a massive credit report. They're like getting a report from all 3 credit bureaus. It's a very involved thing. That's not something that we can pull, but we can pull our credit reports from each bureau. It used to be once per year per bureau, but since COVID, you can now pull that credit report once per year. I mean, you can now pull it once per week per bureau, free. It's on the ftc.gov website, or you can go to annualcreditreport.com. But if you're looking into possibly buying a house in the near future, you don't want any mistakes in your credit report right out of the gate. So it's just a great idea to just pull it and look through it, make sure everything in there is what it's supposed to be, nothing in there that you don't know about. You want to get that stuff kind of taken care of out front. So just know you don't have to wait a year or anything else. You can go this week. And if you wanted to, you could pull all 3 credit reports from TransUnion, Equifax, and Experian and just look them over, make sure they made them pretty easy to read now. And on their websites, they walk you through it much better than they used to, but it's worth taking a look at ahead of the mortgage, ahead of getting into that mortgage process. So here's a question for you, Scott. Can I have a little more explanation on a VA loan? How does the 0% down payment with $2 and 2.3% loan amount work?
Okay, so it sounds like you're referring to the funding fee. Basically, if you're buying a house for 500,000, let's say, and depending on your circumstance, if you're not disabled and you're under that in that chart, the 2.3% range, you would calculate out the funding fee based on that, and that would be rolled into your loan amount. So that is one of the extremely rare circumstances where a lender will give you a loan amount that is higher than the purchase price. That is probably the only scenario where that will happen. I'm not sure if that fully answered your question or not, but
You can follow up if you like. So they're charging you a fee as opposed to a down payment, and that fee is 2.3% of the sales price.
yeah, so they have the funding fee, which is basically what goes to support the VA home loan program. It is waived if you're a disabled veteran, but they do charge that funding fee to help support the VA home loan program in general, basically. You don't have to put a down payment. You also won't have mortgage insurance on that. Instead, they charge an upfront funding fee that they use to invest and cycle back into the VA loans.
Very good, and thank you too for your service. Appreciate it very much. So, Leah, I don't have any more questions. I think we're all set on our end. I hope everybody found that helpful. I will be sending a link to the recording to you. I can also make the slides available if anybody would like those.
Yes, that would be great. Thank you, Scott. Thank you, Bill. A lot of great information here. Just want to quickly add that if folks are interested in looking into a loan from their retirement plan, you can do that online at oaretirement.com. And if you have any questions about that, feel free to reach out. And also, if you need an employment verification during the mortgage and loan process, we'd be happy to do that. We do those all the time. We actually have an automated employment verification line, which is open 24/7. That's extension 8632. So it's the standard TCB number 857-221-8632. Or you can reach out to me or another member of the HR team, and we'd be happy to produce a letter or a verbal verification of employment. We do those all the time. So if anyone has any additional questions, feel free to reach out to us. And thanks all for the time today.